discuss today, which is your standard for leases. A very important standard, not only for academic purposes, from exam point of view, but also from your practical aspect. Like all of your, I'm sure that all of you people are working accountants and you have leases, and previously which were not leases, now you have to convert them into leases, etc. Whatever. Let's have a little bit of the overview about the previous standard. The old standard was IS 17. IS 17 was cancelled out. There was a long debate which was going on for several years. In fact, actually, the standard took like 6 or 7 years before it became before IFRS 16 came into implementation. IS 17 was there, but IS 17 was unable to handle some issues. And the two major problems which IS 17 was creating for the users of financial statements were: number one problem, that IS 17 off balance sheet financing, we call it off balance sheet financing. So this is one problem with IS 17. It was unable to handle this problem. And the second was sale and leaseback. So these are sale and leaseback transactions. So these were the two deficiencies, or you can say lackings, with IS 17. And therefore, there was a big room for manipulation of numbers. So financial statements were like manipulated by using IS 17 provisions. After this new standard IFRS 16 came into existence or came into power, this off-balance sheet financing is absolutely not possible. Sale and leaseback, it is still possible, but the conditions have become very tough. So you still have sale and leaseback transactions, but conditions are quite tough, and off-balance sheet financing is gone. Now, what is off-balance sheet financing? What is sale and leaseback, and how do they, impact the financial statements? This is we are going to discuss, because once you understand these two things, you will understand the purpose of IFRS 16 leases, the objective. So you need to understand that, the creators of the new standard, what was in their mind, what they were trying to achieve, what was the objective of the standard. Because once you understand the purpose and objective of the standard, then it becomes, you have, more objective application of the standard. Because many times in real life, you will see that there are situations for which you do not have exact guidance from the standard. So when you do not have exact guidance, but at least you know the purpose and objective, so your judgment-based application becomes more in line with the objective of the standard. So you have to make judgment-based application, and your judgment should be in line with the purpose of the standard. Now, let me tell you that what happened that in IS 17, I'm still talking about the old standard, because I believe that before I go to IFRS 16, I need to discuss 17 well. Because in any case, 16 and 17, there are quite many things which are, similar, in fact, same. So once we understand IS 17, some IFRS 16 is automatically covered. So under IS 17, there were two types of lease arrangements. We call them operating lease. We use the exact word like operating lease, and we called it finance lease. Okay. So an operating lease was a simple rental agreement. It was a simple rental agreement. So it is like you take some equipment or you take some asset on rent purposes. So you pay the monthly rents or annual rent, and nothing goes to SOFP. So nothing goes to statement of financial position, because rental agreements are in P&L. You take an asset, you use it, you pay the rent. You are not the owner of the asset, so you don't take it to the balance sheet. You just put it in your income statement, P&L. Whereas in the finance lease, again, you pay the rentals, lease rentals, but you become the owner of the asset. And for this purpose, there was for finance lease, there was no issue. So you take the asset to your statement of financial position, and whatever interest you pay, interest goes to P&L, or depreciation goes to P&L. You become the owner. So you make lease rental payments, 1 year, 2 year, 3 year, 4 year, and from the day one when you make the agreement, you consider yourself as the owner. So finance lease was just like purchasing the asset on credit. Finance lease, you can consider it like when you purchase the asset, and you purchase the asset on credit, that I'm buying the asset now and I will make some payments in the future. So I am the owner. I have not paid the money full. I'm going to pay 1 million in 5 years. But from the day one, I am the owner. And you take asset to your balance sheet and you start calculating depreciation, etc. under finance lease. Finance lease was kind of okay. We were okay with finance lease. The problem was with operating lease. The problem was the big part of the problem, it lied with the operating lease. Now, what problem it gives in the operating lease, that we are going to discuss. So we said that IS 17, the old standard, it had first issue, which was off balance sheet financing. Okay, off balance sheet financing, which means that a business has acquired financing, but it is not shown on the balance sheet. How does it work, or how did it work in past? See what happens. Remember that you have two financial statements. One financial statement is P&L, and one financial statement is SOFP. On balance sheet, you have assets, and these assets, either you have purchased through equity or you have purchased through debt, which means that maybe you purchase the asset with your own money, maybe you purchase the asset on loan, or maybe there is a combination of financing. Anyways, the asset is on the balance sheet, and this asset, you use it in the business, and as a result, you generate profits. Okay, and we have our return on assets ratio, return on equity ratio. We have got our asset turnover ratio, which tells us that how the management is or asset utilization ratio, which tells us that how effectively the management of the business, they are utilizing the assets of the business. For example, you have got, let's suppose, 10 million in assets and you've got 1 million in profit. So you say that our return on asset is 10%. Kind of management is using the 10 million worth of assets and producing 1 million in the profits. And we know that there is a relationship between assets, because whenever we purchase new asset, whenever we add some more value to the balance sheet, we purchase new assets. It is expected that these assets will be used in the business and they are supposed to generate more profits. Let's suppose if my assets, they go to 11 million, I expect that my profit should be 1 million plus X dollars. I expect that 1 million I have invested more, so I should be getting some return more. So that is what your ratio analysis, which we do interpretation of financial statements, and we do ratios. This is what we expect. Like assets are increasing, we are making more investments. As a result of more investment, these investments will bring some return, bring some profit, and that profit will be reflected on my P&L. So there is a relationship which is in my mind. Now imagine that this is in 1 year, and then in second year, you still have 10 million worth of assets, and your profits, they go to 3 million. And now it looks like something like 33% return. You would be kind of surprised, actually happily surprised. Everybody would be happy. Oh, I did not make any investment. I did not purchase more assets. My balance sheet size is still the same, and my P&L has shown some amazing results. So let's bring this team of management and let's reward them, and let's put some medals to them that they did an amazing job. Actually, this is what they did. They did off balance sheet financing. Now, this is the exact scenario. This is the outcome. This is the actually outcome of your off-balance sheet financing, which I say. Because what did they do? The management, they just went on, because now let's suppose that this is a company which is, airline company. This is an airline company. Or it could be a property rental company. It could be a car rental company, anything. What they did, they leased three aircrafts. They leased 3 aircrafts, and they got the aircrafts on operating lease. Operating lease means that the lease contract said that they will be paying rentals for using the planes for a period of 3 years or 5 years. Plane has a life of 20 years, and they said, I'm going to make a contract for 3 years only. So when they make a contract for 3 years, according to IS 17, the old standard, where if the asset has a longer life and you only use for a very short period of that life, you are not the owner, because this is one of the criteria of IS 17. So I'm not going into detailed criteria of IS 17. We don't need that. But just to give you a clue that because the airplane had 20-year life, they made a contract for 3 years. It was not classified as finance lease. It was classified as operating lease. And when it came in as operating lease, nothing goes to the balance sheet. Nothing goes to the balance sheet. They are paying rental, which is, let's suppose, I don't know, 1 million or 2 million or 3 million per year. And the aircrafts, they start operations, they start their flights, and the revenue starts coming in. The profits start adding up, but nothing goes to the balance sheet. So this is what you say off balance sheet financing. So they actually took an asset and they started using the asset. The benefits of the using the asset start flowing into your P&L. Your P&L starts receiving the benefits, but the value of the asset is not reflected on the balance sheet. P&L is being impacted, balance sheet is untouched. And suddenly your ratio analysis, your interpretations, your numbers are upside down. Now, what is the problem with that? The problem is that most of the users of the financial statements, they only see these numbers. They only see these numbers. They do not know, and they do not have access to the actual contract which was being made. It is possible that when they got this thing on 3 years lease, they had a contract that they would pay a fixed lease rental, whether the plane would fly, whether the plane would not fly. They cannot cancel the contract after 1 year. They have to continue for the next 5 years or something. So there are some conditions in the contract, those conditions which are not favorable for you. You don't see the contract. You only see the number. You don't have access to those long commercial contracts. And then what happens? That at some point in time, you don't have the business, you don't have passengers, you don't have the flights, but you need to pay the rentals, and you go into loss in future. You actually are exposing yourself to some kind of risk which the users of financial statements do not know. So off-balance sheet financing, it was handled through operating lease. Operating lease created this condition of arranging off-balance sheet financing in which businesses were attracting assets, they were using assets, they were generating the revenue, they were making the profits, but they were not showing them on their asset base in the statement of financial position. This was one side of the story. Now, what is the size of this off-balance sheet financing? I don't exactly remember the number, because this number I read something 3-4 years ago when this IFRS 16 was introduced and everybody was doing more research. So I think the number was something close to, if I'm not wrong, something like $20 trillion. 20 trillion USD. This is the size of off-balance sheet financing, out of which I think only 12 trillion is in the US. Only 12 trillion is in the US. This is the size of off-balance sheet financing, global size. I'm not talking about US, only global size. This is the amount to which businesses have attracted assets to their financial positions and not showing them onto their balance sheet. And therefore, the results are distorted. I would not say manipulated. Manipulated is a bit of a rude word. I would use the word rather distort. So the results were distorted and the risks were unknown. You never knew what kind of contracts your management has signed. You only find it out when there is a big bust. Okay, then you see that we are locked into these contracts. This was one thing which is off-balance sheet financing, and this is strictly prohibited in the IFRS 16. Because IS 17 actually created some conditions when we said that IS 17 has operating lease and it has financing lease. So financing lease had 1, 2, 3, 4, 5 criteria. Which lease can be called a finance lease? One, when you make a full payment. Full payment means that the present value of the future payments is equal to the present value of the asset. Which means if the asset is 5 million today, and then I keep on paying in 5 years this amount. So if I pay these amounts and the present value comes too close to 5, it means it is a finance lease. It makes sense that the value of asset is 5. You have committed to pay 5 in future. Present value of that is 5. It means that you are purchasing the asset. You are the owner. You take it to finance lease. Finance lease is okay because finance lease you take it to the balance sheet. Okay. Under finance lease you take it to the balance sheet. So making it or classifying it as a finance lease is not an issue. The problem was that it was a kind of finance lease, but they were classifying it under operating lease. How did they get it? Because the second condition was that useful life. That what is the useful life of the asset and what is your contract? If they say that useful life of the asset is 5 years and you have a contract for 5 years, it means nobody else is going to use it. Only you are the user of this asset, so you are owner. So let's put it under finance lease. But if the life of the asset is 5 years, but you have a contract of only 2 years. So as soon as you see this condition, this thing is transferred to this part. You say, oh, now it is a finance lease because the asset has a total life of 5 years. I'm going to use it for 2 years. I'm not an owner. So this is how we took it under operating lease. Imagine your rental properties. You have rented an office and you have been paying rent for last 10 years. And you are not putting it into your balance sheet. Every year you pay rent and you take the rent into the income statement. Nothing is going to the balance sheet. Because you said that the building has a life of 40 years. My contract is only for 3 years. After 3 years, I may or may not renew. But in reality, you are renewing, you are setting, and you are using the asset. And you know what? That building is on the prime spot. It is in a commercial location, which has a lot of customers. It's a very valuable building. It is like, maybe the value of the building or the office value of your shop. Maybe you have a restaurant, maybe you have a shop, which works on location, and it is on prime location. The value of that small piece of restaurant on that particular location might be 5 million. It's a small place, but it gives a lot of money because it's on prime location. But you have a 3-year contract. You say that's my operating lease. That's not my finance lease. And thus you put it on your income, you classify it as an operating lease, you just show it on the P&L, you take the benefits to your P&L income statement, but nothing goes to the balance sheet. So it looks like with a very small balance sheet, you are making very big profits. And that business looks, super marvelous, super interesting. Small assets, huge profits. This was the issue of off-balance sheet financing. this has been removed. Now off-balance sheet financing is not possible because under the new standard IFRS 16, even if the asset has a 20 years life and even you have only a 3-year contract, still you will be considered as the owner. At least you are the owner for this period. You are not the owner for 20 years. It is your asset. So, and we will consider it. We have to create a new term. We call it ROU, right of use asset. So it still goes to your balance sheet for a period of 3 years. We say that. So IFRS 16 says that it is not necessary. It is not compulsory that you make a contract for the entire life of the asset. Not necessary. Asset is for 20 years. You have a contract for 3 years. So at least for next 3 years, you are the owner. At least for next 3 years, you are, this is your asset. So take it to the balance sheet for a period of 3 years. Instead of not taking it to the balance sheet at all, let's take it to the balance sheet for 3 years. So, and now off balance sheet is gone because the asset for the usage of 3 years, we calculate the value. Of course, we will not take the full 5. So let's suppose the asset is for 5 million, the total value. I'm not owner of 5 million. I have committed 3 years. So whatever money I have committed for 3 years, at least this is my value of asset. So this much, how do you calculate it? We will calculate it later. We will learn it later. But something should be taken to the balance sheet. Maybe 1 million, maybe 2 million. Something should be taken to the balance sheet. So this was issue of off-balance sheet financing, which IFRS 16 has solved. I'm sure that you would understand and you would agree with me that off-balance sheet financing was unable to create a relationship between the P&L and the balance sheet. Because we said that your P&L and your balance sheet are related to each other. Your P&L is a reflection of the assets and liabilities you have. But IS 17 was unable. The second issue was about sale and leaseback. Sale and leaseback. This issue is not completely removed. Sale and leaseback is still allowed under IFRS 16, but there are some more, I would say that, more conditions they have attached. It has become tougher than what it was before. So sale and leaseback, what happens? On your balance sheet, you've got your assets. Might be you have some PPE, with the value of your PPE is, 10 million. This is the net book value. What you do that, you sell this asset for 13 million, and then you get it back again on a lease. So you don't have any intention of selling the asset actually, because asset is still used by your business. It is a premises. You are not leaving the premises, or it is an equipment, and you are not going to stop the production. So you will continue your production process. So you need the asset. But what you do, you sell it to a third party, and then you lease it back. You probably lease it back for, 2 million per year. You made a new contract. It's just like, I sold my house, and then I make a rental agreement with the new buyer that, okay, I'm selling you this house. Are you going to live in here? He said, no, I'm not going to live. Okay, I will continue to live. So I sell it to you, you give me the money, and then I make a rental agreement with you, and I start paying rent to you. So this sale and lease back. Now what happened? One, the company improved the liquidity. Number two, now they are no more. This asset is no more on the balance sheet. They have converted it into cash, so their cash position improves. They recognize this because asset value was 10 million. They sold it for 13 million. So 3 million profit, it goes to the P&L because it is a realized profit. Remember, if you do revaluation, so when you do revaluation of a non-current asset, the 3 million, which is revaluation gain, does not go to P&L. It remains in other comprehensive income because we say that it is unrealized gain. But as soon as I sell my asset, I realize this 3 million because it has been realized. I get the cash. 3 million straight goes to P&L. From P&L, it goes to retained earnings. From retained earnings, it goes to dividends. Dividends. Cash has gone out. Asset is still there, and you are still using the asset, and you are still getting the same benefits. So sale and leaseback also created confusions, but it is actually the way you need to do business, and it is your choice. Now, IFRS should not be telling me that should I sell my asset or not. I am the owner of the asset. I can sell it, and I am the owner of the asset tomorrow. I can buy it. But IFRS, it has created certain, conditions that if you are doing it, these are the conditions under which you can realize this profit or not. The big question is, this profit should we realize it or not? Because that would be a manipulation. So one thing we decide on this thing, and another thing that whether the sale took place or not. So sale and leaseback, like I said, that it is still possible, but and with some new conditions attached. This is IFRS IS 17, two major problems, which have been solved by IFRS 16. Now, how IFRS 16 solves these problems or these issues, this is what we are going to learn in our second session. Of course, now after 5 minutes, we'll start it. Again, now we are going to do how IFRS 16 solves these issues. Any questions you have, you can ask me. Okay, so we had some good 30 minutes of overview on comparison of IFRS 16 and IS 17. So you understand the problems with IS 17 and how IFRS 16 is going to solve these problems. Let's now start IFRS 16. Now, before I move on, again, actually, very short comparison that in IS 17, you had two types of leasing: operating lease, we discussed this before, and you had a finance lease, okay? Finance lease. Under IFRS 16, what you call it a lease, and you call it a contract. That's a service contract, okay? And what is actually happening that you should consider that finance lease is something which was before considered as finance lease. The lease is something which you previously called finance lease. So finance lease was where you become the owner. You become the owner. And this is where you are the tenant or the user, okay? So the word operating lease now is just considered as a service contract. So this thing, operating lease, has been replaced by the word service contract, and finance lease, you call it a lease now. This is one thing. Then you have always two words. You call it a lessor and you call it a lessee. And this terminology is same. Under IS 17 or IFRS 16, lessor is one who gives the asset, and lessee is one who receives the asset, okay? Who received the asset. Now, you should remember that for this part, which is your lessor, your IS 17, the old standard, and the new standard IFRS 16, they are same. The treatment is same. The treatment of lessor, the one who is giving the asset, is same. There is no change in the lessor accounting. The change is the IFRS 16 only impacted your lessee accounting. And mostly we are actually the lessees. From exam point of view, generally 99% of the times they will give you the situation where you are a lessee, where you have received an asset. So when you are receiving the asset, for example, you have rented a car, you have rented a plane, you have rented an office, you have rented some equipment, that is the lessee treatment. And this is what you should be doing. I give you a fantastic example from my personal experience. Remember that I said that there's an asset with 20 years of life and you are using it and still not taking it to the balance sheet. Actually, I did it myself. When I was working in a company from 2011 to 2018 in oil and gas, in one of our entities, we were using some equipment which we call HTDU. HTDU. That's an expensive equipment. And actually, I joined the company in 2011, and this equipment was already there. I kept on using it until 2018, and it was still there. And it actually came many years back. It came to us in 2006 or so. And we were using, there were 4 pieces of this equipment. And we were paying, for every piece, we were paying something like $252,000 per month. No, I'm sorry. My total rental for 4 pieces was $252,000 per month. So 1 month's rental was $252,000 for all these 4 equipments. So in a year, you can calculate how much it makes. It makes something like 2.5 million or 3 million I paid annual rental. And I kept it as an operating lease. I never took it to my balance sheet. And we got huge money out of that. Nothing on the balance sheet, everything on the P&L. So anyways, let's remove this thing. So you have a lessor, you have a lessee. The accounting for lessor, it remains the same for the previous standard IAS 17 and the new IFRS 16. The changes with the lessee accounting. Okay, so now we start with the words. We say that why a new leasing standard? I already explained to you that you were, getting a lot of equipment, and that equipment, it goes to off-balance sheet financing. Off-balance sheet financing means that you were taking the asset and you were putting it onto, not putting it onto on your statement of financial position, not taking the impact of the asset and liability on the balance sheet, but just taking the profits and putting the profits, reflecting them into your P&L. Let me now, what I need to do, let me just go back to Excel. And do you guys see the Excel sheet now? Yeah. So let me just quickly again, I will write down again the conditions for IAS 17. I promise that I'm not going to speak about 17, but without speaking 17, 16 doesn't come in. So the rule actually was that when you see an asset, first you decided that is it your finance lease or not. If it is not finance lease, if it does not meet the finance lease criteria, we used to call it an operating lease. So every time you see a contract and you see that okay, finance lease has 5 criteria, do I see these 5 criteria? If any one of them is there, or does it meet the criteria for finance lease? It is fine. If it does not, it is operating lease. The criteria under IAS 17 were that present value of future lease payments are equal to or more than the present value of the asset. So that defines you as finance lease. This is IAS 17 finance lease criteria. We said that this is a lease which is called finance lease because I'm paying the total value of the asset. Or the lease contract is for the useful life of the asset. The asset has a life of 5 years. You are also using it for 5 years, so you are the only owner. The lessee has a right to extend the lease contract upon expiry. So if you are the lessee and you have a 3 years contract, but you have a right to extend the contract again. So it means that you will continue using it. So nobody else is using it. So only you are the person who is getting economic benefits from this asset. You are the owner. It is finance lease. And the lessee has a right to purchase the asset at a very nominal price at the end of the contract. So at the end of the contract, you as a lessee, you have a right to purchase the asset at a very nominal price. So it means that when the contract will finish, it is very likely that you will purchase this asset. You will purchase this asset because it is available at a very nominal price. So you had a 5 years contract, then at a very nominal price, you purchase it. And once you purchase it, you will continue to use it. So you are the only person who's going to use the asset. You are the owner of the asset. And then, risks and reward criteria came in. And, the repair and maintenance thing we said, repair and maintenance, who's going to do the repair and maintenance stuff. So these things will also decide that if you are doing the major repairs, so it means that you are the owner, otherwise you would not do that. So together, these things, they help us to decide if it is a finance lease or not. So if these criteria are not met, then you said it is operating lease. If these criteria are met, you call it a finance lease. And once it is finance lease, once you decide that it is finance lease, what you did, you take asset on the statement of financial position, recognize the liability on standard of financial position, statement of financial position, make lease payments, interest to P&L, and principal reduced from liability. For example, if I make a lease payment of 1,000, within 1,000, this 100 is interest, 900 is principal, 100 used to go to P&L, 900 will be reduced from my liability, This was the treatment. And then because you recognize the asset, you also charge depreciation in P&L. So the finance lease has, a full-fledged treatment. And finance lease is considered as purchasing an asset on credit. So you just assume that I'm getting the asset, but I will pay money in future. So this is my asset. It goes to my balance sheet. The commitment which I made, the lease contract, 1 million, whatever, that I take it to my balance sheet as my liability. Every month or every year, I make the lease payment. That lease payment has principal and interest. Interest goes to my P&L, and the principal is reduced from my liability. And then this asset also reduces from the balance sheet by way of charging the depreciation. It makes sense. This is the treatment of an asset. But under operating lease, you had only one thing, that is charge rental to P&L. That's it. Operating lease was like you are in heaven. You use the asset, nothing on balance sheet, no asset, no liability, no interest payment, no depreciation, nothing. Just keep on paying the monthly or annual rentals and take them to the P&L. And therefore, what happened that many times the management, they wanted or they manipulated to bring most of the assets here. They used to bring assets here. How did they bring the assets here? Because they said that this condition is not being met. Because asset has a life of 20 years, I'm only taking it for 3 years. Condition number 2 fails, I take it to operating lease. This is what we were doing before. Now, under IFRS 16 said that I am not seeing these criteria. These criteria are dead. These criteria are gone with IAS 17. We don't talk about these criteria because based on these criteria, we classified between operating and finance lease. Then when this new standard came, IFRS 16 when it comes in, it said I'm not talking about these criteria anymore. What I'm talking about is that The entity has an uninterrupted. Now, I'm not using the language of the standard. I'm just using a casual language, but the message will be conveyed. The entity has an uninterrupted right to use the asset, which means that you have control. You have control, and the asset is identified. These are the two main focus points. That you have an uninterrupted right to use the asset, which means that you can use it the way you want. For example, if I have taken a shop on rent for a period of 1 year or 2 years, so I just rented the shop. Now I'm going to open up there. Maybe I will make some gift shop. Maybe I will make a flower shop there. Maybe I will make, a pharmacy there, or maybe I will just make, I don't know, some cosmetics shop selling cosmetics. It's my choice. It is called uninterrupted right to use. So when they give me the shop, they say it is in your control. Do whatever you want to do. This is first condition. And the second condition is that asset is identified. Which shop? This shop. Identified asset. There is a big plaza. There are many shops, and they will give me which shop they want. It is not identified. Asset is identified. That office number 7 on 10th floor. We are making a contract for office number 7 on 10th floor for a period of 3 years. You go and maybe you open a travel agency there. Maybe you open a cargo company there. Maybe you open an audit firm there. It is your choice. So once these two conditions are there, we say that there is a lease exists. A lease exists. And when I say a lease exists, what does that mean? It means that the finance lease exists. Just like when I say lease under IFRS 16 means the finance lease under IFRS 16. Under IFRS 17, and these conditions will apply. No more these 4 or 5 difficult complex criteria. Just one this thing. Yes, there are some exemptions which we are going to discuss. Now, if you see this criteria, you know what? I'm sure you would be afraid now because you have been renting an office. You have been using an office on rent for last 5 or 7 years, and you pay the rent every month, every year, whatever, and you never take that office on your balance sheet because you said, "Oh, this is my rental premises. It is not my asset." Now you have to take it onto your balance sheet if it has an uninterrupted right to use the asset, and if the asset is identified. Take it for 3 years, take it for 4 years, take it at a smaller value, but take it to the balance sheet and start making this treatment. Take asset on the statement of financial position, and here I would say not asset, take right of use asset. Now, this is the new terminology which has come in with IFRS 16. It never existed before. Take right of use asset. You don't call it asset because it does not belong to me. I'm not the legal owner of that, but I have a right of use asset. Recognize the lease liability, make the lease payments, and charge depreciation on ROU, right of use asset, right of use asset in your P&L. So now, if I consider now the simplified definition, a lot of the assets which have been used by different companies or which have been for many years, they are going to be classified into assets now. Like you had premises. It was not onto your balance sheet. Now it is going to go to your balance sheet. Now, sometimes assets, like if you go deep down into the explanation, when I say uninterrupted right to use, this one word was important. And I said that the asset is identified. Asset is identified. Now, this one is also important to understand. So both of these conditions are important. Sometimes, because they will play a role. For example, identified asset. Let's suppose that you rent a car from a company, Avis Rent a Car. It's Toyota Camry, and you have a 1 month or maybe monthly contract for 6 months or 8 months or 1 year, whatever. Sometimes you have made a contract for a 1600cc car, or maybe for even you mentioned that it is Toyota Camry, but you did not mention the registration number. They will send the car of their choice. After 1 week, they take that car back and they give you another car with another registration number. Asset is not identified. If this is the situation, then you are not talking about lease. We say lease exists. Then there is no lease. Then there is a service contract. If there's a service contract, this is a service contract which was previously called operating lease. Okay, which was previously called operating lease. And what do you do with that? You just record rental, charge rental to P&L, because asset is not identified. Asset is not identified. So you can say that I don't have control over asset. I don't have uninterrupted right to use. Uninterrupted right to use. They give you a car, or maybe they give you a shop, and they say that Jinesh, you can only open up a pharmacy here. I will not allow you to open a cafe here. Only a pharmacy. That's all. Pharmacy is the only business I'm allowing. So when they say that you can only open a pharmacy here, it means that you don't have uninterrupted right to use. Asset is identified, but I don't have the control of the asset. I cannot use it the way I want. Control is still with them because they don't let me do something else. Again, that's a service contract. So you need to see these two conditions: that uninterrupted use and identified asset. If these two conditions exist, call it a lease. Lease means my old finance lease. Consider it as your asset, at least for the time being. Because when I say that it is my asset, I did not say it is my asset. I said that it is my right of use asset. So I have a right of using this asset. Asset might have 20 years life. I just made a contract for 3 years. So at least for 3 years, I will take it into my statement of financial position. And how do I find out the value of right of use asset? This was a shop, okay? And the shop had a value of 2 million. Of course, I made a contract of 3 years. And naturally speaking, in 3 years, I'm not going to pay 2 million to them. My rental is 100,000 or 200,000 per year. So you find out. Now, we are going to discuss it in more detail, what is under right of use asset valuation. But primarily, you should remember that any payments which you make for the future payments, the present value of the future lease payments, plus any advances, plus any investment which you do on that asset for making it construction for yourself or something, that all of that should come into right of use asset. And then you depreciate it over a period of 3 years or 4 years, whatever is your contract. If these two conditions are missing, you call it a service contract and you charge it to rental to the P&L. There are two exceptions, because I'm sure that some of you might be thinking that life is going to become very tough after IFRS 16, because I had a lot of assets which had a lot of contracts which previously I considered them as rental contracts. I never took them onto the balance sheet. So after IFRS 16, I need to do everything to the statement of financial position. That's going to be pretty tough. So IFRS gives you two exceptions. One exception is they call it small value assets, small value contracts. So if you have a rental contract which is supposed to be less than 5 months, then consider it as a service contract, and don't take to SOFP. So this is, they give you first exception. They said that, okay, don't be worried. If you have some small value contracts, which means less than, small value contracts, which mean less than, I'm sorry, less than USD 5,000, no need to take it to balance sheet. It's amount which is less than 5,000 amount. We call it small value contract. Consider it as a rental contract and take it to your, don't take it to your SOFP and charge to P&L, No need to recognize the asset and liability. Consider it as a rental agreement and just pay the rent. And the second was short-term contracts. Short-term contracts also considered as service contracts, rentals, charge to P&L, which means that these two categories, you can consider them as your operating lease. Remember the last one, IS 17 operating lease? So these are the two exceptions. Short-term contract means less than 1 year. So you have a contract for 6 months or 8 months. In any case, even if you take it to the balance sheet, it will be depreciated within 1 year. So why do you take it to the balance sheet? Whatever you pay, that will be removed from the balance sheet in any case, because it has a life less than 1 year. So just make it simple, take it also to the P&L. And now our smart accountants have started manipulating this thing, because accountants, they love off-balance sheet financing. Actually, accountants do not love the finance people, they love it more. Accountants, they are, I would say that, I don't blame them. This comes from the finance people. Short-term contracts, they use it for off-balance sheet financing, because IFRS 16 gives them a hope that if a contract is for less than 1 year, you can consider it as a service contract and take it to P&L, charge it to P&L. So they have this office, which they want to take on rent. This is a premises. Let me make some office like this. They have an intention of 5 years, but what do? They make 1 year contracts every time. I'm renting a premises to open up a cafe, and I have got this understanding with the owner. I'm not going out. I'm staying here for 5 years, but I'll make annual contracts, because when I make an annual contract, it comes under the classification of short-term contract, which means that charge to P&L, don't take to balance sheet. So again, that objective of off-balance sheet financing is achieved by reducing the term of the contract, which of course is unethical and auditors will not allow it. But somehow they try to manipulate the situation. Am I clear on that? Okay. So we understood the basics. Now let's go to little details. Again, I'm going back to the PowerPoint thing, and let me see. So lessee faces major changes. Like I told you that the problem with the lessor is not an issue. Lessor gave the asset, he had receivable, whatever. The problem is with the lessee. Lessee is the person who's receiving the asset, and the classification has changed. Treatment I wouldn't say has changed, classification has changed, and because of the classification, then the treatment has changed. So what lessee has on balance sheet asset, which is called right of use asset, he has a liability obligation to make lease payments for the next 3 or 5 years. In the P&L, he will charge the depreciation, and then he will charge the interest, and that is called front-loaded total lease expense. Now, front-loaded. Now, this terminology actually is called front-load means when you pay something upfront, when you pay something in the beginning of the years. So beginning of the years, depreciation also comes in, interest also comes in. If you see that, this is exactly the same treatment which was under finance lease. So because of the change classification, this asset was, before I was calling it operating lease, now I call it lease, finance lease. So the finance lease treatment will be applied. Companies with operating leases will appear to be more asset rich, but also more heavily indebted. So those companies which had a lot of operating leases before, after this IFRS 16 comes in, they will renew they will change their accounting treatment. Assets will be added up onto the balance sheets, and also liabilities. So the balance sheet, asset and liability things will change. Total lease expense will be front loaded, even when cash rentals are constant. Front loaded because when you will take the asset, you have to charge the depreciation of that asset, and that is going to be big money. So which means that initial years, it will be front loaded, which means that more expense will go to P&L in the beginning of the years. Impact on financial ratios, profit and loss EBITDA may go up, balance sheet total assets will go up, gearing ratio will go up because you have more liabilities. Your EPS in early years, because it is front loaded, so you have more expense there. So EPS will go down, net assets will go down because you will recognize the liabilities, and interest cover and asset turnover ratios will go down. So these were the ratios which are really very important to understand the financial position of an entity, and these ratios were distorted in past. I'm telling you about the impact on financial ratios. Now, the question remains still there. So this is old standard, new standard. I already explained this thing. I will upload these slides. If you want to review, you can review. But I already explained you what is off-balance sheet, what is a new standard, what is an old standard. In old standard, you call it finance lease. Now you call it lease. You had operating lease. Now you call it a service contract. Lease definition, contract or part of a contract that conveys the right to use an asset for a period of time in exchange for consideration. IFRS 16 definition. The new definition increases focus on who controls the asset. So new definition is not about if you are going to use the asset for the full life. It is not about if you are going to pay the money. It is more about who controls the asset. And that's why I said uninterrupted use of the asset. If you have uninterrupted use of the asset, you are controlling the asset. You are controlling the asset. It is called your right of use asset. And then identified asset. So these are the two areas which we focus on. One, who controls, and identified. Asset is identified or not. Because if asset is identified, it is a lease. Control, is there an identified asset? Yes. Customer has right to substantially all the economic benefits. If no, it is contract. If yes, it is lease. These are some examples. I'll just read solar farm example. I'll just move on. My purpose is to show you. I'll come back to this slide. Okay, I'll come back to this slide. I just want to quickly jump to the accounting treatment. Two major exemptions. I already explained to you that what are those exemptions. One is short-term lease, which is less than 12 months. One is small value contracts, which is less than 5,000. If these are the things, you take them as a contract. These are not classified as lease, so don't take them to the balance sheet. Here, ISB has been generous so that accountants do not have to account for small value or small term contracts, because when you call it a lease, you have to recognize into balance sheet. You have to calculate the right of use asset value, then you will depreciate it. On annual basis, you will record the liability. So it becomes more complicated. Just to make life easier, these two small things they have excluded. Make the standard easier to apply. Otherwise, you will have a lot of small leases, and you will sit down and start calculating their asset values and the depreciations, etc. These are two exemptions. How do you measure the lease liability? This is the question. So the lease liability is the present value of lease rentals. So you have, you would be paying 1 million, 1 million, 1 million in the next 5 years. You find out the present value by discounting it to your back, if you remember, and you find out the present value of expected payments at the end of the lease. If you have any other promised payments at the end of the lease. So this is sometimes we have some payments like, I have 1 million. Let me just correct it. So there are, for some reason, I need to pay 1 million every year, 1 million here. And this is end, I pay 1 million plus 200K. 200K is to bring the asset to present condition, whatever. So this together will make my lease liability. So it could be a provision or something. So this is your lease liability. And what is your lease payments? So lease payments could be different types of lease payments are. It could be a fixed payment, like 1 million per year. It could be a variable lease payment, only for index or rate at commencement. So there are some type of payments which are paid on, some expected. I give you an example. I was using an equipment for which I was paying a fixed amount, plus I was paying the processing fee per ton, which I process, because they know that if I'm using it for 24 hours, I'm processing more, or maybe if I'm using it for 12 hours, I'm processing less. So it changes the useful life of the asset. And when you have large contracts, for example, an aircraft, you have a fixed lease amount plus the number of hours you fly the plane. So you might have some variable lease payments as well. Then you might have some residual value guarantees at amount lessee expects to pay, which I said that you have to pay at the end of the day, end of the lease contract. Remember I said that last year you have to pay 200, whatever. That also goes into your asset. And purchase option exercise price. This usually you wouldn't see in SEC exams, but this, it's a little bit more detailed thing. If lessee reasonably certain to exercise, which means that at the end of the lease period, you have a right to buy the asset at a certain price. So that also can come into it. Or plus payments of terminating the lease, if lease term reflects termination by lessee. So generally what you have here, you wouldn't see these three in for academic purposes. They are very much to large contracts for practical purposes. And by the way, it is also sometimes you get some in your right of use asset. How do you calculate? In right of use asset, you got lease liability, the present value of that 1 million, 1 million, 1 million, plus initial direct cost. If I incur some direct cost here, some amount, maybe for arranging the lease. Remember when you purchase an asset, so whatever you incur for acquiring the asset, you pay some commissions, whatever. So that is added here because it is an asset. So whatever comes into asset, plus any prepayments, maybe I made some down payment of 200K or 300K. It is also possible sometime. And restore and dismantle. The last period payment, 300,000. Remember, I said that 200,000 you have to pay to restore it, like provision or something. These four you will add. And minus incentive receipt. Minus incentive receipt. You subtract it. Because I have a lease liability, the present value of lease liability is, 2.5 million. Plus I paid 0.3 million to acquire this asset. Plus I paid $500,000 as a prepayment or advance or something. Plus I have a provision of restoring it 0.2. So this total makes me 3.5 million. And then incentive receipt, because it is possible that sometimes they give you the asset. Very interestingly, we call it reverse premium. Okay, reverse premium is like I'm getting an asset, and I agree to make sign this contract, and the lessor, the person who's giving me the asset, he gives me 200K cash just to sign the contract. He says, if you agree with these terms and conditions of paying me 1 million, 1 million, 1 million for 3 years like this, and you also because you have to incur some initial direct cost, because you know what, when I come inside, I say I'm willing to take your asset, fine, but the thing is that it is not in operational condition. I need to make some renovation. I need to make some, structural changes. I wouldn't call them, but some kind of furnishing or renovation I need to do. And I have to spend money. I'm staying here for only 3 years. Why should I be spending money on that? And even if I agree to spend, your asset will be improved. So you know what? I have to pay this money. I have to pay this money. And he says, okay, if you sign the contract under these conditions, I will give you 200,000 cash today. So he gives me the key and he gives me the cash. He says, take my asset and take the cash and start using it. So this 200K is called incentive. So the right of use asset now will become 3.5, which you incur to pay or spend on this asset, minus this 200K which this person has given you, the lessor which has given you 200K. So 3.3 is your right of use asset. You have a 3 years life, divide it with 3 and take 1.1 million as depreciation. So incentive receipt, it is called, by the way, reverse premium, and that is a liability to us. And then it actually decreases my lease rentals. That's very interesting treatment. I will show you sometime later, because what happened that I am paying 1 million in 3 years in cash. But this incentive, it is going to decrease my 1 million, because actually net I'm not paying 1 million. In order to pay 1 million, I also have received from him 300,000. So this incentive receipt is a liability. Imagine that these things are not there. Okay, imagine these things are not there. Let me show you how it will happen. And I agree with him. Let me show you how it happens. Lease liability, because on day one he will give me. Let's suppose he gives me 300,000. So on day one I would say debit cash. Now this is purely for accountants, my accounting friends, and credit lease liability 300, because he has given me 300,000 today, and I promise to pay 1 million every year. If I take the money and then I say thank you very much, I sign the contract, I take 300,000. 3 days later I come back, I say I don't want to lease it. Would he let me walk away with 300,000? He say, okay, if you don't want to take your asset, give me back my 300,000. So this 300,000 is my lease liability. Now how much rental I have committed with him? I have committed with him 3 million, but from this 3 million, 0.3 I have received in advance. So actually I'm going to pay him 2.7 million, and that 2.7 million is for 3 years. So my actual rental is only 0.9 million now. Now end of year one, I would say debit lease rental 900K, because my rent expense is 900. Debit lease liability 100K, and credit cash 1 million. This is how I'm going to remove this lease liability. So if you see that, first I created the lease liability. Of 300K, and then I calculate my expense. My lease expense is only 900K, but I'm paying out cash 1 million. So credit cash 1 million, debit your rent expense, lease expense, which is 900, that goes to P&L, and reduce the lease liability. Lease liability I'm decreasing. So this is in year 1, and then in year 2, I will again make a debit to lease liability, and then in year 3, I will again make a debit to lease liability, and this lease liability will be removed from my balance sheet by adjusting that difference of 100K every year. So I have actually my expense in 2 years' time, I'm going to pay him 2.7, and therefore 2.7 will go to my income statement. 900, 900, 900. This 300 I received in advance and then I return back. I took it as a liability and then I'm paying it back. Are we clear on this then? The double entries. If you are not clear, I can put them again. Maybe they're not really very in order. Okay. Then you have, so right of use asset, you know how to measure. So right of use asset measurement is the lease liability, any indirect costs, initial direct cost you pay, for arranging that lease agreement. You make some prepayment, some, deposits or something. You have some restoration costs, dismantling costs, all of them will be added. And if you have any reverse premium, you subtract it. In some cases, there is no reverse premium. If there is, you will subtract it. Lesser accounting remains similar to current practice. So if we come about to lesser accounting will be done the same way as it is done under the current IAS 17 or the previous IAS 17. You do lease classification test, finance lease and operating lease, and nothing changes. Because for the lessor, it's not an issue. Because lessor is giving away the asset. If it is operating lease, he receives the rent. If it is finance lease, he has sold the asset. He has sold the asset, and asset he will remove from his books. So in case of, let's suppose that in case of in IFRS 16, let's speak like this. I'm talking about the new standard, okay? And the previous is also the same. You have a lease, and you have a contract. So if it is a contract, and I'm talking about lessor. So if it is a contract, the asset remains with the lessor. He only receives the rental income, and that goes to P&L. Asset remains with the lessor, and the lessor will keep on charging the depreciation to the asset. No problem with that. But if it is a lease, and you have given a right of use asset, now this is where it is like you have given the asset now for that particular period of time. So what happened previously, that you removed the asset. When you had a finance lease in past, you consider it as you sold the asset, and payments are only coming in future. So lessor removes the asset from the balance sheet and does not charge depreciation. Depreciation is charged by the lessee who is using the asset. He is only getting the payments for that. So for lesser accounting, you won't find much difficulty. And in fact, if you talk about the exam, you would hardly see lesser accounting treatment because that is simply straightforward. You will always get a lessee where they say that you have leased an asset, you have leased an equipment, you have leased some office premises or whatever. Okay, so this is definition. Now comes sale and lease back. Sale and lease back, we will keep it in this next session because that again needs something like 45-50 minutes, maybe even more. Because sale and lease back, we need to also discuss IFRS 15. Because the sale and leaseback transaction, whether the sale has taken place or not, that would be justified according to IFRS 15. And then we need to calculate the right retained and right transferred and the profit on disposal, etc. So that is something we keep it to the next session.